And we have a little bit of a closer look at the residential buy-to-let activity. So this would be straight letting, whether furnished or unfurnished. Now, there's little distinction between the two, as opposed to furnished holiday letting, which we'll come on to in a few minutes' time. You may be aware that accounting for income, that seems sort of a straightforward, well, clearly got to account for the income. But some changes came in April 2017, where HMRC sort of changed the default position. And what they say now is broadly, subject to a few details within the legislation, that if you're an unincorporated landlord and your rental income is 150,000 or less, the default way for you to account for your rental profits is on a cash basis. So that's what it says, it's cash in a particular year, less expenses out. And some argue that that's a much more simpler way and approach to the taxation of this income. The problems arise where you may have already been accounted under what's called an accruals basis. So you're recognising the rent when it's due, as opposed to when you receive it. You're recognising costs when the liability to pay those costs is incurred, rather than when you actually pay them. So you end up with essentially monies owed to you and monies that you owe at any point in time, and akin to a balance sheet if you're familiar with sort of a set of accounts. The changes are not necessarily designed to cause panic if you have been accounting under an accruals basis and all of a sudden you find yourself in this position where your default basis is a cash basis. Just be mindful when preparing your self-assessment tax returns. You may have agents, but if you're doing them yourself, there is a box on the tax return to say, hang on a minute, I don't want to go onto a cash basis, I want to continue as I am, and in that basis you can continue to account for under an accruals basis, which is probably what most of you have been doing along the way. But obviously if it's favourable to go onto a cash basis, that's a discussion for you to have with your advisors, there is now that default position in the background. So aside from that, what can we claim against your rental income? There's a few areas listed there under allowable expenditure. We have obviously letting costs, so advertising for new tenants, checks at the start, agents' fees for finding the tenants, all those sort of things are clearly deductible. Ongoing management fees, where you've got an in-situ agent, again deductible. Repairs, maintenance, utilities, council tax, all of those things, service charges, ground rents, all the usual costs are there and can still be deducted as they were before. Travel costs is something as well. Sometimes people overlook claiming, but if you've got a number of properties, you spend a lot of time doing things for those properties, you can look at maybe claiming a mileage claim for use of your vehicle in looking after them. What generally we say to clients is keep a log of where you're going, what you're doing, how it supports your rental business activity, and then we can claim an appropriate mileage deduction against your profits, which is certainly worth doing at 45 pence a mile for your first 10,000 miles. It can be quite a good way of reducing your tax exposure. Final point there, mortgage interest. We're going to look at that in a little bit more detail because, as you're probably all aware, there's been quite a lot of changes in that area, so I won't go into that now. In a few slides' time, we'll have a closer look at what's been changing there. But the principle is, to the extent that you've got a mortgage on the property and there's the interest cost, not the capital repayment, but the interest cost, there is potential for relief, but the way the relief is going to work is changing.